All right, chapter 17 is our next chapter, and what we want to look at here is a type of cost accounting system. There are two types of cost accounting systems that, depending on the type of products that are being manufactured. One is called job order cost systems, and the other is called process costing system. Job order cost systems are meant primarily for custom jobs, unique jobs, whereas process costing systems are meant for mass-produced, homogeneous, look-alike type items. And so what we're going to focus in on is job order cost systems, although many of the concepts are applicable or related to process costing systems as well. So we're just going to concentrate on job order cost systems. All right, so what is a cost accounting system? Well, it serves several purposes. And the main thing that these managerial or cost accounting systems are meant to do is help management make better decisions. Well, how do they help management make better decisions? Well, how would you know what to charge your customers if you didn't know how much it cost you to produce a unit of product? It would be very difficult. Obviously, you want to charge more for the product than what it cost you to make that unit of product. And so what cost accounting systems do is help determine the cost of making each particular manufactured item. The cost accounting system's meant to help with assessing the efficiency and effectiveness of operations. Obviously, if it's costing more to manufacture a product than what you could charge for it, you're not being very efficient and certainly not very effective. Planning and control functions, we talked about that. It's about being able to plan what you're going to manufacture and being able to control costs as you go along and hopefully make corrective action before it's too late. And of course, it's all about providing products and services to customers. That's the main goal. You've got to produce a product that's sufficiently of certain quality but cheap enough to be able to sell it for more than what you manufacture it for. I mean, you're never going to produce a product for more than what you could charge for it, not for very long anyway. Some other things to consider are that cost accounting systems are the procedures and techniques used by management. So it's not just about the numbers, it's about procedures and techniques. And so these procedures and techniques that are used by management are used to evaluate and reward employee performance. Sometimes it's not rewarding, sometimes it's corrective action, or even if it's bad enough, firing employees, It's about managing activities that consume resources. When you make a product, you are consuming resources, materials, labor, overhead, etc., etc. And so this cost accounting system is about being able to track those activities that consume resources and making sure that they're being efficient in the use of those resources. And the other part of this is tracking the resources consumed by products and services. All right, so job order costing system. As I mentioned, it's used for production of large, unique, high-cost items. These items are built to order rather than mass-produced. Think of an airplane. Not Boeing. When they build an airplane for a particular airline, that airline might have certain things that they want and need in an airplane that another airline company might not want or need. So, custom built stuff is the kind used for job order costing. And so your typical job order cost applications are applicable in special order printing, again, custom, building construction. But note here, it's not just about manufacturing. It can also be used in service companies that are fairly custom type service companies. And so hospitals use this stuff, law firms use this stuff, and accounting firms use this stuff because they can track the costs of working on a project or a job, if you will, to certain customers for the most part. So let's concentrate on manufacturing type companies. How does the process start? Well, it usually starts with an order being, or a request, if you will, being made by the customer to do whatever it is that the company does. Again, Boeing gets a request for 10 new airplanes. From, let's say, Southwest Airlines. Great. They agree upon a price, sign a contract, etc., etc. Now it's time to build. And usually what they do in the contract is there's this job or these jobs, if you will, because each airplane actually is a separate job. Usually there's a start time by which the job must be started, and usually there's a delivery date. In other words, the job must be completed by a certain amount of time. Well, let's say it's time to start the job. What do you do then? Well, you're gonna line up the resources needed to do the job. So what could that include? Well, it'll include ordering materials needed for the job. After determining what is needed, you order them. Employees. Do you have enough labor to complete the job? You might need to hire some new employees, additional employees. You might need to train them. You might need to hire temporary employees. So there's all kinds of things that go into this before you can actually start the process. But that's all part of this cost accounting system as well. And so once you have all your resources that you need for the job to do the job, you begin production. Now remember, direct materials are those materials that can be directly traced to a particular job. We put X amount of I don't know what they build, what they have airplanes, when they build them, the outer shell, but it looks like, I don't know, some sort of aluminum, rolled aluminum or something like that. But, let's say it takes 10,000 sheets of aluminum, this rolled aluminum, to make the shell of a jet. Well, that's a cost that can be directly traced to that jet, which is a job. Well, let's say you have 10 employees who are working on this plane, again, which is a job. The cost of paying those employees can be directly traced to that job as well. So everything focuses around the job, or jobs if it's plural. And then on top of direct materials, direct labor, you've got this manufacturing overhead. Indirect materials, usually items too small to track separately, are billed to factory overhead and then applied to jobs at the end of the job. And indirect labor, those parts of, or those labor costs that cannot be directly traced to a job, such as manufacturing supervisors who might supervise several jobs, are indirect. Maintenance workers are indirect. Janitor, the cleanup crew, who cleans up for several different departments, would be an indirect labor cost. So that all becomes part of manufacturing overhead and is applied to each job using what we call a predetermined overhead rate. All right, so in this little example, you've got 3 jobs. You're going to track the direct material cost for each job. You're going to track the direct labor cost for each job. And then you're going to apply manufacturing overhead. And how this is done, this predetermined overhead rate, is you're going to, and we'll see this here in a few minutes, you're going to apply overhead to each job using this predetermined overhead rate, and it's going to be based upon some cost driver. Now, cost drivers can be something that's rationally related to the overhead. And so, for example, a cost driver for a job that's heavily labor intensive would be rationally related to direct labor costs. What if it's not labor intensive but machine hour intensive? In other words, a machine produces a product, and that's the major cost involved in producing the product. Well, the cost driver there would be machine hours. So those are the two main. There are other cost drivers you can use that we'll talk about, but those are two examples. All right, so the overhead application rate, the POHR, is used to apply overhead to jobs and is determined before the period begins. Well, why is that? Well, the reason why is because you're doing these jobs throughout the year, and you don't know actual overhead rate, the actual amount of overhead, until the end of the accounting period. And so what you do is you predict the amount of overhead that you're going to incur during the year. And, of course, if you've got a proper planning system and historical information about costs, you can pretty well get close to, in your planned overhead or your estimated overhead, very close to actual. Not exact, but pretty close. And so your predetermined overhead rate is calculated using a numerator of estimated total manufacturing overhead cost for the upcoming period. And you're going to divide that into the estimated total number of units in the activity base that you've chosen for the coming period. So let's say that your estimated total manufacturing overhead cost is $500,000 or $5 million. Let's use 500,000, less zeros. You're a small manufacturing company. So 500,000 is your total manufacturing overhead cost that you estimate for the upcoming year. And the activity base that you've decided to use, the cost driver that you've decided to use, is direct labor, because it's a fairly labor intensive type of job that you're doing in manufacturing this product. So the rational basis there, the rational relationship between overhead costs and making this product is direct labor costs. let's say that in this case, you estimate 10,000 labor hours will be used during the year. And so there, what your overhead rate would be is the 500,000 estimated cost divided into the estimated direct labor hours that you plan to spend on jobs during the current year. And so note here, actual overhead for the periods not known until the end of the period. All right, so we're doing these jobs throughout the year. How do we apply overhead? Well, we take this predetermined overhead rate that was decided at the beginning of the year, and we multiply it times actual activity. So the actual activity is the actual amount of the cost drivers, such as units produced, direct labor hours, or machine hours incurred during the period. Let's say that we finish a job and it took, and our cost driver is direct labor hours, and it took 100 hours to do this one job. Well, in my example before, let's see here, 500,000 divided into 10,000 equals $50. So your predetermined overhead rate per direct labor hour is $50. And so what you're going to do in my example, let's say it takes 100 hours to actually do a job. You're going to multiply 50, your predetermined overhead rate, times 100 hours, the actual time it took to produce a particular product. So in that example, you're going to apply $5,000 of overhead to that particular job. Here we have an example of a company, CompuLine, which kind of sounds like they build computers or something like that. Applies overhead based on direct labor hours. The total estimated overhead for the year, remember we're setting up our predetermined overhead rate here, is 360,000. The total estimated labor hours are 30,000. So you're going to take and divide 360,000 into 30,000 estimated labor hours. So you're going to come up with predetermined overhead rate of $12,000. Excuse me, 12. My phone calculator's off. $12 per direct labor hour. And so for each direct labor hour worked on a job, you will apply $12 of manufacturing overhead to a particular job. So if you spent, again, 100 hours on that particular job, you would multiply the 100 hours actual times the $12 per hour to come up with the actual overhead you apply to that particular job. All right, so let's talk about how we track these material costs, labor costs, and overhead costs. The primary document for tracking costs is this thing called a job cost sheet. And so this is an example of a job cost sheet. This could be paper-based, but more and more companies are going to a computer-based job cost sheet, but they pretty much look the same. It's just one is on paper, the other is electronically based. And so look at this. You got the name of the company. It identifies this as a job cost sheet. Apparently this is job 831. You know, the job before that was job 830. The job after that obviously would be 832. So they're going sequentially with their job numbers. It indicates the product being produced, the number of units, the date started, and the date that it's completed. Now that's not going to be filled in until it's actually completed. And then here you've got two different departments involved in manufacturing. You got the milling department and you got the finishing department. And so as milling does their thing, they're going to put in the amount of direct materials that they use. We'll show how they do that in a minute. Finishing is going to show how much materials they use. Direct labor is recorded, 70 in milling, 300 in finishing, and of course the cost of that. And then over to the right we have, again, using direct labor hours as our example. Again, we're billing this manufacturing overhead based upon 150% of direct labor cost. So if direct labor cost in milling is $14,000, they've determined that the predetermined overhead rate is going to be 150% of that. So that's where they come up with the 21,000. Same for finishing. And so you've got your total costs of direct materials used. You've got your direct labor cost, and you have your manufacturing overhead applied for the total cost of the job, and then you sum that up with your cost of finished goods manufacturing of 100 tables, total cost of 75,000. You've made 100 tables, so that's a unit cost of $750. Does it mean that it actually was each table took $750 worth of resources to make? Well, maybe not, but on average, that's the cost of making a table. Now, back to how we track these costs. Direct materials. Usually what you're going to have is you're going to have a warehouse or something like that that's going to store the direct materials before they're used, before the job starts. And so when the production manager is ready to start production, they're going to fill out what we call a materials requisition form, and someone above him is going to have to sign off and approve this. Again, this is about control, and one of the things you want to control is your inventory, to make sure that the raw materials inventory that you have is not being stolen or used improperly. So that's, again, part of internal controls is you have separate departments handling this stuff. So you've got a separate warehouse department that's handling raw materials inventory. They get the materials requisition form from production. The higher ups sign off on it, and based upon those authorizations, the materials are sent to production. Now, direct labor is accumulated, the cost of direct labor is accumulated usually through what we call time tickets. Now, again, this can be paper-based, but a lot of times it's electronic-based. Same concept, though. You know how much time that a worker is working on a particular job because they've recorded it. And so the sum of all workers working on a particular job are summed together to come up with the amount of direct labor costs. And then again, before the year even starts, you have estimated the amount of overhead costs you're going to incur. You've determined the rationally related cost driver and the amount of estimated time that you're going to spend throughout the year on particular jobs to come up with your manufacturing or predetermined overhead rate. And you're going to apply overhead based upon the rate to this particular job. So again, they have predetermined the overhead rate to be 150% of actual costs, direct labor costs. And so you apply the predetermined overhead rate to the actual cost of $20,000. Well, 150% of $20,000 is $30,000. Now, note that the materials requisitions aren't just for direct material costs that go to the job sheets. These are also used for indirect materials. Again, screws. You're not going to track the cost of each screw in a job, okay? And so that's going to be an indirect material charged to overhead. Direct labor is going to be reflected in these job cost sheets through what each employee records on their time ticket. And then you're going to have these time tickets also used for indirect labor. So let's say you have a supervisor that spends time supervising two different departments. they're going to allocate the overhead cost of that supervisor to the two departments based upon the time he spends in each department, I suppose, which comes is reflected in the employee time ticket. So note here the things that are included in manufacturing overhead. You've got indirect labor, indirect material, and then there are other actual overhead charges such as insurance, utilities, maintenance, custodial, etc., etc., etc. And so somehow, some way, they figure out how much is allocated to a particular department and then allocate to the jobs using the predetermined overhead rate. So here we have our T accounts, something you should already be familiar with. And so we've got materials inventory account, you've got your manufacturing overhead account, and your work in process account. And so materials inventory, you make a purchase, you're going to debit materials inventory, right? When a requisition comes, either for direct material or indirect material, if it's direct material, it's going to go to the work in process inventory account. And if it's indirect material, it becomes a debit in the manufacturing overhead account. For labor, direct labor is going to go also to work in process inventory account. As far as indirect labor, it becomes a part of the manufacturing overhead account. And then the overhead is applied to the particular work in process based upon the predetermined overhead rate. When the job is completed, and usually this overhead applied is done at the very end of the job, obviously, because it doesn't make any sense to apply it any sooner, but it has to be applied before we can figure out our cost of goods manufactured. And so again, we apply our overhead, debit that amount. Once the job's done, it becomes cost of goods manufactured that transfers over to the finished goods inventory. And then when the goods are sold, that cost becomes the cost of goods sold for those particular products that are sold. Now understand that the predetermined amount of overhead that you plan on at the beginning of the accounting period is not necessarily actual overhead costs incurred, and so you could have an over application or an under application of overhead. When you've under applied overhead, meaning that your applied overhead is less than actual overhead, what you've got to do is you've got to increase your cost of goods sold to even that out. If manufacturing overhead is over applied, then that means applied overhead is greater than the actual overhead. And then if in that case, what you do is you decrease cost of goods sold. All right, we're going to skip activity-based accounting, and I think there may be a few closing matters that we need to talk about. So hold on one second. Let's get to that. Let's look at this. No, that's not it. Sorry. Let's talk a little bit about ethics, fraud, and corporate governance. Understand that this stuff goes into our financial statements. The stuff we do, the cost we apply to jobs that we do have an effect on the financial statements. And so there is the possibility, if you are of a certain unethical mind really, to maybe understate the cost of jobs. Because if you understate the cost of jobs, then you can show more income, net income. And so understand that the failure to allocate corporate overhead properly can result in misleading financial statements. So what happens there? Well, if you're a public company and you're involved in this knowingly, then there could be repercussions from government regulatory groups, from the stock exchange that your stock's traded on. You could be fired, depending on the criminality of it. You could be incarcerated. So it's pretty major stuff for companies not traded on public exchange. Still, if you're using these financial statements to obtain loans and stuff like that, you still could get in trouble for fraud-related charges in that case if you're out there getting loans based upon these financial statements. So it's pretty serious stuff, and you really need to make sure that you do everything possible to make sure that the numbers are as correct or reasonably correct as they can be. So that's the end of our lecture for chapter 17.